Hi guys, in this video I will explain you what are the assertions. Especially if you are a beginner in auditing career, this will help you to understand the assertions that we have to audit. So the assertions are defined in ISA 315, identifying and assessing the risk of material misstatement. So as per this standard, assertions are representations with respect to recognition, presentation, disclosure of information in financial statements inherent in management, representing that financial statements are prepared in accordance with applicable financial reporting framework. For example, if your client is in Australia, they imply that we have prepared financial statements according to Australian accounting standards. So they basically say they have identified the transactions and events and their assets and liabilities, also the equity, according to Australian accounting standards in the financial statements. So as auditors, we are going to see whether that is correct, whether there is any deviations from our financial reporting framework. So as auditors, we use assertions to consider different types of potential misstatements and assessing and responding to risk of material misstatements. When we talk about assertions, we can identify these assertions separately under two headings. What are the assertions applicable to statement of profit or loss and other comprehensive income? And what are the assertions that are applicable to statement of financial position? First, we will see what are the assertions about the classes of transactions and events and related disclosures for the financial year. So in simple word, these are the assertions that relates to P&L. So guys, I'll be referring the statement of profit or loss and other comprehensive income as P&L because that the current name is quite too long. So the first assertion is occurrence. That means the transactions and events have occurred and pertains to the entity. For example, if there is a sales transaction recorded, management assert that this particular sales transactions has actually occurred during the period and that relates to our entity. So normally to verify this, we do vouching to source documents. So I'll be giving you some examples of audit procedures that would address particular assertions, but I don't guarantee that this is the only audit procedure you can do to verify that particular assertion. I'm just giving you few examples along the video. So next assertions is completeness. That means all transactions and event related disclosures that should have been recorded have been recorded. So they assert everything that they should have recorded have been recorded. So to verify this, normally we do tracing from source documents. So some get confused this. Some people think vouching also can verify the completeness, which is wrong. If something is not recorded, how do you verify it? Normally in vouching, we select the sample from the GL and then go vouch source document. But if a transaction has not been recorded, we are not going to pick it as a sample to verify. So we can't verify the completeness from vouching. So we have to trace from source documents to verify whether that transaction has been recorded. Next assertion is the accuracy. There they assert amounts and other data relating to recorded transaction and events are appropriate and related disclosures are appropriately measured and described. One of main audit procedure that we do to verify accuracy is vouching to source documents. When you vouch to source documents, you have to check whether the date, amount and the transaction description is agreed with what is said by the source documents. That's how we verify the accuracy of a transaction or event. And for example, if it is like interest income or right of use asset calculation, you can do recalculation and verify accuracy. And next assertion is cut off. There, what they are telling is the transactions are recorded in the correct accounting period. Think about a scenario where the company sells products to customers, and according to their policy, they can recognize revenue only if they deliver the products to customers. And say they raise the invoice on 30th June 2021, which is the year end date, and they are going to deliver the products to customers on the following days, which is 1st July 2021. So if they recognize the revenue of those goods for the financial year 2021, it is incorrect because the goods are delivered on the following date and they have to recognize that revenue on the following year. So we do cut-off testing on revenue to verify there are no such cases. To verify the all recorded transactions are recorded in the correct accounting period. Next assertion is classification, which is quite understandable. That is, the transactions and events should be recorded in the proper account. For example, if you record a gas bill in electricity account, it is incorrect. There is a classification error. Next assertion is presentation. So you might have seen at the end of each accounting standard, they give list of disclosures relating to that particular accounting standard. So when a company claims that their financial statements are in accordance with the accounting standard, they have to adhere to these disclosure requirements as well. So in presentation, we review financials and ensure that the recommended disclosures are presented in financial statement according to their financial reporting framework. Those were the assertions relating to P&L. Now we are going to see what are the assertions in relation to balance sheet. Assertions about account balances and related disclosures at the period end. The first assertion is existence. Assets, liabilities, and equity interests exist. If an asset or liability is recorded, whether that is actually in existence. We are going to verify this by vouching to source document, maybe calling confirmation or check subsequent bank transactions. We can do several audit procedures to verify the existence of an asset, liability, or equity. And the next assertion is rights and obligation. If it's an asset, we have to verify whether the entity has a right to that asset, or if it's a liability, we have to verify whether there is an obligation to pay in future. Again, we can take audit procedure vouching to source documents. And next assertion is the completeness. All assets, liabilities, and equity interests that should have been recorded, and all related disclosures that should have been included in the financial statements have been included. So regarding disclosures, we can do review of financial statement, and regarding asset, liabilities, and equity, we can again do tracing from source documents, confirmation calling, reconciliations, cut-off testing at end, many audit procedures on this assertion in relation to balance sheet. And the next assertion is accuracy, valuation, and allocation. So what this means in the appropriate amounts result in valuation or allocation adjustments have been appropriately recorded, and if it's regarding disclosures, those have been appropriately measured and described. Again, we can do vouching, recalculations, and here if it's a complex calculation on valuation, you can use auditors experts, or if management has used their experts, we can use their work as well. There are separate auditing standards on those topics that I'll cover in later videos. And the next assertion is the classification. Again, same like the topic we talked in previously regarding P&L, the transaction should be recorded in the correct account. And next, presentation. Again, they have to appropriately disclose according to requirements of the accounting standards. Again, regarding disclosures, we can do review of financial statements. So those concludes the assertions in relation to balance sheet. So it didn't take much time to talk about the assertions from balance sheet side because we have already covered most of it in the P&L section. So in summary, what are the assertions that we have to verify in regarding to transactions and event? That it's actually happened, all recorded, amounts and details are correct, and recorded in the correct financial year, and recorded in correct account, and appropriately presented. And when it comes to balance sheet, asset, liabilities, and equity, we have to verify that those were actually exist, owned by the company or payable by the company, and all recognized, accurate, valued correctly, and recorded correct account and appropriately presented. So this concludes the lesson on assertions. I hope you have learned something on assertions. See you in the next video. Thank you guys.